All right. Good morning, everybody. We're getting closer. We're still in the hurry up and wait mode, waiting on CPI, waiting for the Fed minutes. So market is maintaining this sideways chop, and we've got gold pushing higher into that 2375 area. And that's going to be reflected in a NASDAQ that really struggles to advance. So it's not necessarily a bad thing. It certainly gives those long gold trades a little more freedom. But I would be cautious with gold once the indexes do begin moving. So if the NASDAQ tomorrow after CPI starts making that push to the upside, then I would probably lock in some profits on your gold positions. Japan down the most. Speaking of Japan, it was on the news more than once this morning that Buffett looks to be increasing his stake in Japan, like doubling down. He was seen picking up a bunch of bonds, so they're speculating on his increased position, which they don't have to speculate for long. Buffett will have to report what he's doing, and everybody will be able to see it. But on the other side of that, the Finance Juice had a little post this morning that Microsoft is going bigger. What was the post? I want to make sure I say this right. Microsoft to invest 2.9 billion in Japanese data centers. So that was on the back of it. And they didn't mention that this morning when they were talking about Buffett, just that Buffett's focused on Japan, which he already has been. That's not a surprise, but that he's increasing his stake there. And now we see this. And I've been doing a lot of research into different ways to play AI. And energy is one of the biggest things that is holding it back. I used to work at an electrical company that built and salvaged transformers. So I kind of understand a little bit about that. And I got friends that work there, and I was asking one of my buddies yesterday about it, if they'd seen, a significant increase in transformer, purchases and demand. And of course, yeah, he has. So these data centers go to the heart of that. Every new data center for AI is struggling with energy. So it's like one of the biggest issues right now. So Japan's down the most. Europe behind that. The Dow basically flat. Hong Kong, which has economic data coming out next Tuesday, it's going to be a really big deal. They're already gearing up for that. They're basically flat this morning. If the economic data looks good, the China ADRs, BABA, Baidu, JD, PDD, that basket of stocks really should finally start to get that move that everybody's been looking for. S&P basically flat, same with small caps, and leading the pack at only 0.15% this morning is the NASDAQ. But make no mistake, it's just flat out there. This is a hurry up and wait scenario. If you're not used to that phrase, that means we're going to play the edges. We don't expect expansion. Sell into strength, buy into weakness, or sell the rips, buy the dips. Say it however you want. Just remember that expansions in a range like that build out into like a megaphone pattern, and that liquidity resides on the other side of the pivot. So when we get to the high, we expect to break through it just to go a little bit higher, run into liquidity and come back in. And when we get below it, just a little bit lower, we run into liquidity and we come back in, and that slowly builds out that megaphone. We do have additional auctions today. It's all up in the front end. So you could use something like IRX, the 13-week, to kind of get a view of that. We can see Japan's got data tonight, PPI. It's kind of a big deal. Our PPI is Friday, CPI tomorrow. And Yellen is still over there chipping teeth, not really gaining traction at this point. Doesn't seem like she's getting anywhere. The spot gamma note this morning laid out some levels for SPY and for the SPX for CPI tomorrow. Now, they don't know where it's going any more than anybody else knows where it's going, right? And they don't know if the data is going to be positive or negative. So, of course, they gave a plus and a minus, bullish and a bearish, but they were laying out the options levels and like a little bit of gravity that price will go to liquidity, right? That's just kind of what it does. It's looking for liquidity. It's going to go to liquidity. So if it's bullish, liquidity is at 525, and if it's bearish, it's at 513. That's the SPY. Now, that's tomorrow's CPI. So SPY having 5 expirations a week, you could pick up some trades today for tomorrow's CPI, possibly at that 525 level. And on SPY, if you're, 7 strikes out of the money, it shouldn't be that expensive, like a lottery ticket. You know what I mean? That a scratch lottery is $1 for a chance to make, a couple 100,000. But there's a reason that you get a chance to win a couple 100,000 for $1. It's because your chances of winning are actually really low. Low chance of winning, low risk. This trade isn't based on trend, momentum, inertia, just on if the data is considered bullish, will go up. If it's considered bearish, will go down. And these are the highest levels of liquidity to target. So sounds like a lottery ticket to me, right? It's something to think about. For the SPX, the levels were 51.50 and 52.65. Now that's going to be a little more pricey, but basically a 50-point move to the downside from where we closed yesterday, and a 65-point move to the upside. 65 points out of the money in the SPX with 1 data expiration's probably still going to have a little bit of cost to it, just right off the bat. I can't think of what that cost would be compared to SPY, but we can just take a peek. Now, remember, the market not being open means that these values aren't going to be accurate, but 52.65. Yeah, you're still looking at about $470. That's not much of a lottery ticket, right? But you could do something like a spread, and then, it's a dollar at that point. So just something to think about for the upside downside targets laid out from spot gamma. All right, we don't have any hedging this morning. The volumes are within a normal range. So nothing unusual there. We've cut through the daily pivot point multiple times, so there's no MDP. We're holding above the volatility trigger. We're holding above this voodoo line. I know it's buried under all that stuff, but there is a forest voodoo line in there. 52.46. We're holding above that. We are right underneath a weekly pivot point, which we tested multiple times yesterday. Actually got above it a few times and came back down. That's this week's weekly pivot point. And I got to say, I like starting the week so close to the pivot point like this. And you can see how we've really been struggling with that pivot point. If we can just get above that thing and especially break through Friday's high, but breaking through Friday's high after resolving this weekly pivot point would put me in a very bearish posture. I wouldn't mind swinging for the rest of the week if we can manage to get that move. ES, MES, SPY, SPX, I don't really care what vehicle I would use at that point. A lot of times when the market is making, good, strong moves, we start the week already above that weekly pivot point by a significant amount. And then, we've already lost a lot of that momentum, that good base to start from, because we're starting so far past it. But I looked at this Monday and thought this was just a fantastic setup if we could hold it. The worry yesterday, of course, was that we would just keep fading away from it and then we wouldn't have the setup. But we kept it. We're still here and we're still pushing against it. There's two schools of analyst thought to a situation where you've got a resistance overhead and the market continuing to press against it without breaking through. Some analysts will say the longer that we stay here pressing against this, the more likely it is that we're going to break through it. The phrase that I use for that is persistence beats resistance. If you keep kicking the door, at some point, you're going to kick through. There's another school of thought that says the market's going to give up if it continues to struggle to fight to get through a level and it continues to not make it through that level, that at some point the market will just throw up its hands and do a wash, kind of back up and start all over again. I don't think that it's a binary decision at this point where one side is right versus the other side is right. I think there's times where each side has a valid argument. Usually the context that comes into it is, why are we holding at this level? Is it just because of that resistance? And no, we're waiting on CPI. So we want to buy the lows and we want to sell the highs on the expectation that we're really not expecting to break out until tomorrow's data. So that means when we get to yesterday's high and we break out, we're going to expect to hit resistance at Friday's high, but we're also going to expect to hit liquidity, which should be sitting up here anyways, because liquidity is on the other side of the pivot. And right now the pivot is Monday's high. Once we get through that liquidity, then we have to get through Friday's high, which is a pivot point. Once we get through that pivot point, well, liquidity resides on the other side of the pivot. There'll be another zone above that one. So it's very likely that we'll sell off into the first zone. And if at that point, the weekly pivot point is support instead of resistance, then it's likely that we run back up and retest this second zone and still sell off. So between now and CPI tomorrow, I still don't see a way that we can even get to the ADR half, let alone continue beyond that. Not yet. We got to get CPI. Having said that, though, 52.75 is not out of line. That would still be playing the edges, that we get into the range, get rejected, get into the next range, get rejected. And all that does is widen our entire playing field, which is what a hurry up and wait scenario generally does anyways. it puts us in a range. And then we slowly press that range a little bit wider and a little bit wider, and we end up with this sort of megaphone pattern. Each time we get to the high, we press just a little bit higher until finally something breaks, either upside or downside, and we get out of it. Same thing with the downside. If we do continue to expand to the downside this morning, and remember, ranges means we expect to play both sides, not just one side. Getting back through the voodoo forest line, being very cautious of this volatility trigger and the 20-day moving average, we could expect to test yesterday's RTH low, which is that voodoo line. Liquidity being on the other side. If we get through that liquidity we get into it, we bounce out of it, come back through it again, we could expect to get tangled up in yesterday's Globex low. And should we get through that, get into our own ADR half and into the next liquidity zone. So we've got multiple levels, multiple layers to contend with. And we've got CPI data that says we shouldn't go anywhere anyways, that we should hold the line, wait till tomorrow, and it's going to look bullish. It's going to look bearish. It's going to look like we're really breaking out and expanding and we're taking off, and you know, that's the trap. That's what it's supposed to do. So of course, there's always the threat that we actually do break out or break down and we get a significant run. And of course, all of us are trying to short the high or buy the low, thinking it's another mean reversion play when it really just continues the run or it just continues the breakdown. There's always that threat. So when we do get to the edges, and we will, at some point today, we're going to get to one of these edges at least, very likely both. But when we get to the edges and we get beyond it, even just a little bit, you don't have to try to short it before we've even started to fall. You can let it get up into that high, go through the high, get into the liquidity, reject off of it, start to fade back down, and then get your short. There's nothing wrong with waiting for it to actually confirm the reversal. Because if it does reject, just like yesterday, when it rejected this pivot from Globex, and it went higher than this pivot point, got into liquidity and fell off, you can see there's plenty of movement here. You didn't have to get it right at the top against those wicks. You can get in after the rollover. So no rush, right? You don't have to guess that we're actually going to reject. Just let it reject it and then join the play. Same thing with the bottom. If we get down here, no reason to buy before we've actually turned around and started coming back up. We don't have a classic shape here, and we're not going to lose this volume along the lows for at least a few more days. So the profile really doesn't have much to offer other than how much time we've spent at our current location, 5253. The TPO, the blue profile here, has the point of control right where we're at right now. And we can already start to see an inverse microphone at this point, a compression pulling this price narrower and narrower. Compression like this will be a breakout, right? But we still don't expect to get much beyond the ranges. Because of liquidity and everything else. So even just slapping a quick line on there, we can see the shallow area. And we get into some volume up there, even all the way out, right? Pretty close to where the point of control's volume is. I know it's a little hard to see with the colors that I use, but there is volume all the way out here, very close to the point of controls volume. So that makes sense that if we break this wedge to the upside and we get to this peak at 52.72, there's resistance right on the other side of it, almost a point of control resistance. There's that much volume there. Plus, there's that many orders there because we're expecting liquidity to be there. Old volume and potential new volume. You can look at it that way. Same thing for a breakdown. Generally speaking, when we move through a zone really fast, we leave a shallow area behind. And that's what we did. So no surprise. But we're still going to be expecting that liquidity to be down here. Liquidity resides on the other side of the pivot. We can say that the pivot is the value area low, but we can also say the pivot are these 2 points of testing there and here from yesterday at 1 and then in Globex. Otherwise, we don't really have a lot from the profile to help us out on the 10-day, 30-minute. No VPOC to carry forward from yesterday. We've cut through that area multiple times. Now that we're on the smaller time frame, you can already start to see that megaphone shape to the downside. Liquidity resides on the other side of the pivot. Every time we go low, we go a little bit lower. Now, generally, the megaphone would expand in both directions. That's where it gets its name, because it presents with that shape. But we're really not expanding on the upside. We're holding really tight up there. So instead, we're getting more of a flat top and an expanding bottom. The outcome is still the same. At some point, there will be a break and price will make that significant move. There's no directional tail. Now, if you look, some wedges tend to break to the upside. Some wedges tend to break to the downside. But we got to add into this that we're connected to a liquidity event and an economic event. And that can skew everything. We've been under the 10 longer now than we have at any other point this year. Back in January, we were under the 10 for 4 days. We're now past that marker. So this is the longest we've been under the 10-day moving average this year. The distance that we get from 10 before reversal is at the lowest point than it's been all year. It hasn't been lower. Maybe we could argue that it's at the same level, but no, it's lower. So what this is saying is that the range that we play on that distance from 10 before we start to say we're overbought and oversold, before we start looking for mean reversion, that distance is the lowest that it's ever been. I use that blue line a lot as a witness of volatility. When volatility is low, that line will come closer to 0. When volatility is high, that line will be farther away from 0. The threat is that the market won't price in the volatility and then we get a big move and the market wasn't prepared for it. Generically speaking, if volatility confuses you, and right now we're just talking like VIX stuff, right? Just VIX. To help kind of ease your mind on what VIX is, because it can be a complex thing. Just think of options volume on the SPX. It's not as simple as that, but really, if you narrow it down to that, it can really help you understand what the VIX is doing. So just think of the SPX and its options. The volume of options traded in the SPX moves the VIX. You can look at 30 days out if you want, but 28 to 30 days out, somewhere right around in there. And then just think of it from the idea that inverse relationship. If the S&P goes down, the VIX goes up. So if the VIX is going up, a lot of puts are being traded. And if the VIX goes down, a lot of calls are being traded. And I know that I'm simplifying it a lot, but I've seen people just make a mess out of trying to explain the VIX, and it gets people even more confused than when they started. And all that fancy talk just muddies the water so much that people give up. But if you just think of the VIX as S&P calls and S&P puts, puts are being traded when the VIX goes up, calls are being traded when the VIX goes down. That'll help you understand volatility, at least from the VIX point of view, a lot more. With this blue line, it's very similar in that volatility concept. Now think of it as the distance that we can move. We've been keeping track of how far the 10 is from price. That's what we do with this every day, these histogram bars. When price gets too far away from the 10-period moving average, it will pause and or reverse and go back towards the 10, like mean reversion. That's just what price does, right? There's no magic to it being the 10. If you have an indicator that's called the mean, you can very likely just use that instead of using the 10. But most people that I know just use the 10. So if 10 is the average price or the mean, what we're looking for is to see price maintain a healthy distance away from 10. And when it gets too far away, it tends to pause and give the 10 time to catch up. Then it begins that expansion again. Every once in a while, we get that pullback to kind of get a little bit of a reset, even get a cross under before we maintain that move again, and away we go. So it's just a very generic structure on mean reversion and how far away from the mean we are. But the distance that we get from that mean, and if the reversal is coming quicker each time or is expanding more each time, we use that blue line for that. And right now, we're turning back towards the 10 sooner and sooner and sooner. Each time, we're doing it a little bit faster. On the weekly, however, it's been expanding. Our distance from the 10 has been holding and increasing this whole year, which to me shows the strength of this move to the upside, this duration that we've been in since November, and that it's not done yet. It's kind of getting a little exhausted because this line is flattening out. But we've seen some flattening back here, and it still continued to go, and we've seen some flattening here. That's where we had a pretty deep sell-off into November. We do have to recognize this peak back here, and it wasn't a peak to price. We can see this is about the same point. We pulled back, had that double bottom, and then we continued. But that blue line continued to fade, right? Because as usual, volatility tends to fade as price goes up. We're not even at the fade point yet, but look at this fade through that whole move, and look at this run in price through that whole time frame. So this is why I'm saying that this trend that we're in is not, to me, it's not done. It's just getting started. We've got a good 2 years, maybe a little more, of just a really nice duration in the entire broader market, not just the S&P. You can see the boxes that I drew from this morning earlier here on the daily chart. It's nowhere near the edges of this range, and we're not expecting to get to the edges of this range today. Maybe tomorrow after we get the CPI report, but not today. So a hurry up and wait day. The index is sideways. We're not expecting to get anything out of them. You could find a hot industry or a hot sector that's making moves, but I think you would be better off if you're trying to find something to day trade from the equities side to focus on what we call event-driven names, something that has news, something that's moving because of a catalyst, right? Some CEO that said something, a new product release, somebody got an upgrade or a downgrade, some reason that it's deviating from the group and breaking out while everything else is holding the line, waiting for CPI. We can see nat gas is up. There was a couple articles talking about a disparity between supply and demand on nat gas. If that's true, I think we're finally going to see that pop. But it's not the right season for nat gas if that's supposed to be a cold weather play, right? If it's supposed to be a cold weather play, then we're in the wrong environment. So, it's up again, and it's still got a lot of work to do before I think it's a viable play. But gold miners are both up this morning, and the FANGs are up this morning a little bit. Plus, we're getting some help out of the bonds. China ADRs are on the move. They're just not quite there yet, and semiconductors are up. So we've got a lot of the ingredients that we need for a trend day. And individually, we could see a few of the FANGs continue that expansion, but we're not expecting the indexes to make that expansion. So if the S&P generally is going to represent about 80% of the market, if the S&P is sideways, then we're expecting about 80% of the market to be sideways. Now that's a really generic statement, but on a day-to-day basis, especially when I'm day trading and trying to, calculate, is today even a tradable opportunity? Is it worth my time to sit down and try to find things on the move? If 80% of the market's expected to be sideways, it makes finding the other 20% pretty easy. It's not hard to see things that are breaking out and running when everything else is stagnant and sideways. And it's the right side, right? Semiconductors, technology, even some bonds. So I like those names. If that's what we're going to have making moves to the upside, I like it. It's very likely too that we're going to see the S&P and the NASDAQ try to make those moves to the upside, just not get any follow through. We'll expect that mean reversion. Bitcoin is down. And really that's the only thing that's down, Bitcoin. Huh. Pot stocks, Bitcoin, and that's it. Industrials aren't down enough to be considered down. The pot stocks are still inside yesterday's range, but they are struggling. And Bitcoin, if it wasn't for that big dark pool print, Bitcoin would be completely outside of yesterday's range. But because of that big dark pool print, oh boy. Netanyahu just said Israel is going into Rafah and nothing's going to stop that. So this will be, this could potentially get out of control. We'll see. But for Bitcoin, since we had that big dark pool print, we've got a very wide day to get outside of from yesterday. And yeah, silver, gold miners, basically precious metals, bonds, semiconductors, China ADRs, even uranium's trying to get up there. It's not enough yet. We need a little more out of uranium. But it sure looks like it's trying and it's getting some flows. All right, Baba with this big old dark pool print. Still inside day. It hasn't made the breakover yet or the breakout. And we've got a really wide TRB setup here. I love this setup. Doesn't really matter where you draw it. This is just a visual aid. Price doesn't care, right? So at TRB, trendline breakover, owes us 74.5. If we could get more, if we were drawing it from the top here, eventually it would owe us 82. But just in the short term, the reason that the TRB is such a great setup is because it gives you candles that look like that. That was a TRB setup, and it tried to make the whole run in a single day. That's why it's so awesome. It's not just, oh, I think we're going back to, 75.5. It's, oh, I think we're going back to 75.5 in a single day. That's a huge move. Makes for a great play, right? Plus it's a day trade. TRB setup. There is an argument if if you're loosely interpreting the price patterns, then you've got an inverse head and shoulder too, but it's an ugly head and shoulders. Baidu, another one that we would expect to see doing good this morning. It's not. It's falling out of bed and actually breaking yesterday's low to the downside. So much for the China ADRs, all right? But that's a lower trend line that's getting broke. JD coming up off of the lows from where it closed yesterday, but still not inside day breakout. It's trying. This would be a red to green. If we can open with this gap up intact, that would be a really nice red to green. Be better too if we can open completely outside of yesterday's range. That way, if we do fade back, we can fade into yesterday's high and use it as support and bounce off of that and continue to go higher. At this point, opening under yesterday's high means we're very likely going to hit that as resistance, and then we're going to have to struggle to get through it. PDD, this one making moves in the right direction. Outside yesterday's range, so inside day breakout. It's struggling to keep it at this point, but we do have it. Look at the daily, all these attempts to go lower were bid back up, but we haven't really had any luck going higher either. So trapped right underneath that 120 zone. And this is a tight range. Some side is going to give up at some point. Liquidity is going to fail, and then we'll expand. But at the very least, we can look at this and say, well, liquidity has been across the highs. We could run this from 118 back up into 120, maybe a little bit more than that. NEO and XPEV don't really fit into that China KWeb constituents box or group, but you can see they are bid up, a little bit of pop in NEO. This thing, make no mistake about it, though, if we zoom out, it's just got one direction, big picture. And XPEV, also nice gap up, but also just, keep in mind, it's got one direction and it's been down for a long time. So these aren't, buy and hold swing trade kind of names, not XPEV, not NEO. There's a couple of different bond proxies that you can use besides TLT if you want to do something like HYG. I mean, it's not looking so hot necessarily that route, but maybe TIPS be another one. I'm sure there's others. Those are just the two that come to mind. And of course, TLT itself, that one's looking much better than the two that I just named. Bonds as a long, probably, as a swing long, probably not yet, right? But close. I think there might still be a little bit of work to do. Looking at it from the monthly, I mean, that $80, that's it's probably the line in the sand that we're not going to cross. So if you want to look at it and say that's a low and that we're now working our way up off of those lows, I don't think I could argue against it, but make sure we keep the 50%. This is a quarterly, so I mean, I'm really far out there. We don't want to see this lose that 50%. And sure, I mean, we're going to wick down there and cross below it at some point, but we don't want to see it sustain below that level. And I'd really much rather have a trend line breakover at this point if we want to, take a duration long in bonds. We would need a trend line breakover, so like above 94. If you wanted to be a little more cautious, you could get above this pivot point that's 95. Then you can run it up to 100, right? Everybody be careful, be safe, watch the clock. I'll see y'all tomorrow.